Hey everybody, live on Facebook, LinkedIn, YouTube, X, Instagram, all systems go there. Let's get rid of that banner. Comments are up. You want to come in and say hi, just on whatever platform you're on, come and say hello. Hello, Terry Price on Instagram. Thank you for joining us. Sound is good on Instagram, according to Ashley. Thank you for that. Should we just get going? We should probably just get going. Thank you, Ion. Let's put you on pause. We are good to go. Welcome, everybody. A week in review at Sinclair Range. This is, I wonder if my camera should have been mirrored. Well, if everything seems askew, you know why. I may not have my settings right. Thanks for the check-in on other channels as well. Ashley, happy Halloween, everybody. While we wait for other people to join us, happy Halloween. Did you know that the Inner Circle Deals in Capital is happening next Tuesday, which I believe to be November, what would that be? Let's just check that out right now. That would be November 4, Tuesday, November 4. Come and join us. You're saying to yourself, hey, Scott, what is the Inner Circle Deals in Capital? Well, it is a live, private, free community where founders, executives, advisors come together every 2 weeks on Zoom to pitch deals, share challenges, get feedback, and sharpen their strategies. If you're raising capital, if you're structuring deals, if you're navigating some tough challenges, you come and you join this community, put the effort in, try to show up. And the goals of this community is to build a community, education, deal review, planning review, and deal pitching. So that's what this is all about. Come and join us. Like I said, it's free, it's live, put a commitment in, and it's been going, I don't know how many meetings we've had so far, maybe 6, maybe this will be our 6th one coming up next Tuesday, but it's been fantastic. And at this next meeting, by the way, we have a pitch of a bridge loan on a cannabis deal, which I think is going to be a DIP loan, a debtor in possession. So we will learn about DIP loans and hear a pitch for that. We have a private debt lender coming in to talk to us about deals and how they can help you. We always, at every Inner Circle Deals in Capital, we try to bring in a capital provider so that our community can learn about the different types of capital. We have a Air Force general, retired Air Force general, who is also, by the way, an Inner Circle member. And this guy is fantastic, and he's cutting edge on military procurement and military technologies. And so that should be a fascinating discussion. And if you want to come and join this group, if you want some agenda time, if you want to pitch your deals, like we need more entrepreneurs and founders to come in and pitch to us. Your worst case scenario. This is not like a group of angels that are here to do deals, okay? Although we do have some of that. But it is an opportunity for you to seek advice, get the word out, practice some pitches. That's the intent of this thing. But last meeting, we had a group, Sinovina, come in, and I won't disclose what they do, but it is a private community, but they did a pitch to us. And now we are in the middle of having a discussion, or they are in the middle of having a discussion on a financing that came out directly from that pitch. So it does work. It is good for you if you're in the stage as a business owner where you're dealing with some challenges, or you want to raise some capital. Come and join us at the Inner Circle Deals and Capital. Let's see what's going on that Instagram screen. We're all good. All right. Welcome to the Week in Review at Sinclair Range. My name is Scott Sinclair. I am president, owner, founder of Sinclair Range. And the mission here on this show, on this live stream, is to provide you with some insight into the goings on at Sinclair Range. This is your window into real deals, decisions, day-to-day business adventures. And we have our usual segments, which include lessons learned of the week, interesting file, our deal of the week, struggles of the week, and normally my observations or musings of the week. So let's move right in. We talked about inner circle deals and capital. And in there, I said it's not an angel group. Well, speaking of angel investing, I had a conversation this week with a client who was looking at making some investments. And we talked about this exact topic, not the inner circle deals and capital, but rather angel investing. What is angel investing? There's no, I think in the finance world, there's really no strict definition. There's no strict definitions in anything to do with finance, but particularly angel investing is just sort of something that is a term that we use. But the idea behind it is that an individual, usually a high net worth individual, puts money in some structure into an early stage or transitioning business. Okay. And so if you're a founder, if you're a business owner, you've got a good idea and you need to grow or launch and you need $500,000, you want to get it in equity, and you go to 5 high net worth individuals and say, hey, can you give me 100 grand each? Right? That's angel investing. And those individuals are not like billionaire family offices types that can do the whole 500,000 themselves, but think doctors, dentists, business owners, lawyers, accountants, professionals of that nature. And they like doing these sorts of angel type investments. And that's what that is. And it sounds like a great idea, right? Angel investing is better than demon investing, obviously. But here's a question. If you want to be an angel investor, what should your focus be? Did you even know you should have a focus? Or are you just going to look at every and all deals and somebody says, hey, I want to borrow some money. Yep, we're in the debt business. I want some equity for my startup. Yep, we're in the equity for your startup business. And that is the conversation that I had with our client at Sinclair Range. And here's my advice. I want you to, I know there's a number of sophisticated financial types on here. Tell me what you think. To me, I break angel investing down into maybe 3 broad categories. One would be private debt, usually on distressed or high growth situations. So private debt, equity in an established business, which I would call, for lack of a better term, PE, private equity style equity investment, and venture capital, which is also probably equity or quasi-equity, but it has a different level of risk. You know, it's not a cash flowing stable business like the private equity side. Now, know that when I'm talking about debt versus private equity versus venture capital equity, I'm really not so hung up on the structure as I am on the risk profile of the investment. Okay, that's what we're talking about. Now, the distressed debt or the high growth debt, from our perspective at Sinclair Range, is the exact same thing. It can generate significant returns, well, a decent return, and can be first secured. So really, it's a way to be safe. And obviously, as an investor, if you have a portfolio of distressed debt loans, you're better off than if you just had one distressed debt loan in your portfolio, right? You'd rather have 10 than 1. So if you have some losses, well, you can cover that with the rest of your portfolio. That's always the case in investing, but you could, on a bridge loan, a debtor in possession loan, which you will learn about more at the Inner Circle Deals and Capital on Tuesday, if you want to come join us. Even any slightly hairy working capital loan, you can get a very lucrative rate of return, maybe a minimum of 13% every year, up to 40 plus, depending on how bad things are and the structure and the growth and all that sort of. And you can be secured. So there's your, let's call that your bogey, your target, minimum 13%, and you're secured. So if you're going to look at equity deals, you beat that number because they're not secured. That makes sense to you? So how does private equity work as a business? I explained this from my perspective as well. Well, what do private equity investors do? They buy equity in stable, cash flowing, and growing businesses. That's what they do. The business has got $5 million in EBITDA, earnings before interest, taxes, depreciation, and amortization, and you try to buy them. You try to buy them at a lowish multiple, say 4 times, and then later, 5 years, 7 years, you try to sell them at an 8 times multiple, and you made profit on the spread. So there's one way in private equity to make profit. And as an angel investor, you can also do that. You can walk into whatever business who's trying to raise some money to do whatever, and you can say, yes, I will put 150,000 or 500,000 into this deal, and I'll do it at 4 times EBITDA as my valuation. And I hope that we sell this business in the future for 8 times. And so I made that spread. So that's pretty good. Also, the second way that you profit as private equity is the EBITDA itself grows, right? So you bought in at 4 times on a 4 times multiple on $5 million in EBITDA, and you're selling at an 8 times multiple, but you hope that that $5 million in EBITDA grows to 7 or 8 million over that period of time. So there's a second way to profit as an investor. And as an angel investor, you can also do that. But there is something that's really important that makes the PE world work and get juiced up returns. Because if you have stable EBITDA and you bought in at 4 and you sold at 8 to 10, basically per annum, if it's 5 years, you're going to get to that 13%, 14% per annum rate of return, which you could have got from a debt instrument and been fully secured. Yet you're taking equity risk. So why would you ever do that? Well, the answer is leverage. What a PE fund is able to do is they're able to say, yes, we will buy your business with this stable cash flow, but we're going to borrow a bunch of that money from a financial institution at a fixed and low cost of capital. And then we're going to put up the equity. Just like when you're buying a house, right? If you're buying $1 million home, you need to put down in equity, whatever, $150,000, $200,000, and you get the rest on a mortgage. You leverage it. Well, it's the same for private equity funds buying a business. And then when you sell that house later, you can, even if it's only a few $100,000 in growth in the value of the property, well, that's a few $100,000 applied to only your equity piece, gives you a huge rate of return. And that's what private equity does. So there's the third way. You can't do that as an angel. You can't say, yes, I'll invest $150,000 into your cash flowing business as an angel investor and then go lever it with your bank. That's not going to work for you. And so that's not really a great avenue, in my opinion, for angel investors. What about venture capital? Here's how a venture capital fund works. You've got a whole bunch of smart people out of the best business schools in the world, paid a lot of money to go through hundreds and hundreds of business plans and to select a small sample of those business plans, the best of the best, right? The cream that rose to the top. And then they have and those are the ones that they want to fund. And let's say they fund the 10 best, because that makes easy statistics. So you have a handful of 10 deals in your portfolio as a VC fund. Well, what's going to happen? Well, 2 of them are not going to return your money. They're just going to go bust. You're not going to get your money back. 6 of them are just going to, statistically, are just going to bump along forever. You're not going to get a rate of return, and it's going to be difficult to get your money back, which means that all of the juice, all of the upside has to come from the last 2. 8 of them are going to suck, and 2 of them, theoretically, will knock it out of the park. And remember, this is after you got rid of hundreds and hundreds and hundreds, being reviewed by really, really smart people to select the 10 that you did decide to fund, okay? And if you think about it, that those 2 that are going to give you the home run, go through the math, you have to do probably 5 times your money just to get your principal back to recover from the losses on the other 8. And you probably need 10 times your money to start having a decent return on the whole portfolio. So on those 2 that succeed, you need to have a 10-bagger, probably a lot more, to make up for the problems of the rest of your portfolio. So in venture capital, you have significant portfolio risk in addition to deal risk. Does that make sense? Portfolio risk in addition to deal risk. So what does that mean for an angel investor? Let's say somebody comes to you with one deal and you see that and say, oh, I really like this deal. I want to put $100,000 into that. Should you be doing that? Statistically, remember, 2 out of 10 selected from hundreds by really smart people succeed. 8 out of 10, 80% of deals selected out of hundreds fail. Should you randomly pick one and do that deal? You probably should not. That's not a great thing for an angel investor. Also, if you're looking at a deal and you really want to be in this space, should you be looking at deals that can't possibly generate that tenfold return in 5 to 7 years? Does that even make any sense to you? Right? So should you be investing in your neighbor's restaurant, in the auto shop that somebody, your buddy wants to, your brother-in-law wants to start up? Those things are not going to generate that return. There's a reason that venture capital focuses on tech, high growth, pharmaceuticals, things like that. There's a reason for that. And the reason is you need that juiced up return. So if you want to be an angel and you want to do VC type deals, you need to think to yourself, okay, I need a portfolio. That's number one. And I need a system to vet deals. I need to know that I'm not doing everything I see. And I need to take an amount of money and divide it against a portfolio, right? So for example, I want to be in the angel venture capital business. I have $1 million to spend. I'm going to do 10 or 20 deals at 50,000 to 100,000 each. That's my limit. That's what you can get out of me. I'm not going to put $1 million into one deal. And that's what you need to do. So that was a conversation we had, you financial types on here. I would love your comments if you agree with me on the notes and in the notes to whatever platform you're looking at. And let's move forward. Speaking, by the way, of distressed debt and bridge loans, Sinclair Range announced the deal last night, I believe. And we are seeking, and we being Gord Bursma, one of our managing directors, a debtor in possession loan, a DIP loan. Do you remember I said that we're going to learn about that at the Inner Circle Deals and Capital? This is for a company involved in the production of premium medical grade cannabis, and the company owns a modern cannabis cultivation processing facility in Alberta, Canada, from which it plans to produce premium grade cannabis destined for the medical market and for international market. I mean, in the cannabis world, you want to be in medical, and you want to be, if you're in Canada, anywhere, you want to be exporting, you want to export to Portugal, Australia, places like that. So the company that is looking for this bridge loan will be filing will be under CCAA, Companies Creditors Arrangement Act. If you're in the US, that's very much like your Chapter 11. They tend to do that later in November, and Sinclair Range will be moving in as Chief Restructuring Officer. So we'll be handling the restructuring and the turnaround of this business, but it needs like any deal, it needs capital. You have to have funds to restructure something, and a great way to do that is on a debtor in position, a DIP loan financing. That's what a court order, a judge gives you a court order and says, hey, you've got a super priority lender over everything. There's 3 mortgages on this piece of real estate. Well, you can be first. You can trump all of them. You can trump the bank. It depends on your jurisdiction and the court order, obviously, but that's basically what it is. And so that's a pretty cool investment. This one in particular will be secured by real estate and by equipment and inventory and insured accounts receivable. What you should do if you're interested in this sort of deal is reach out in the notes, and we'll get a non-disclosure agreement signed with the right parties. Where are we on time here? Pretty good. Have you ever heard, speaking of distressed debt, yet again, what a constant theme. Have you ever read or heard of the OPM wire? OPM wire. OPM stands for Other People's Money. The OPM wire is a subscription blog based in Canada focused on the financial industry around Bay Street in Toronto, which is, the hub, the financial center. Bay Street is the Canadian Wall Street, okay, or Midtown. The content of this blog, I don't spend a lot of time on it, but it's investigative, and according to my artificial intelligence, it is polemical. Am I saying that properly? Polemical? I don't even know what that word means, so I'm just going to skip that. But it's in tone covering hedge funds, private funds, wealth managers, and the air quotes Bay Street establishment. To me, it's a little bit gossipy, to be honest, but they've got some interesting stuff in there. And some of the interesting stuff is that they have been covering and written a number of articles on a fund management company out of Toronto by the name of 9 Point Private Debt. 9 Point Private Debt. And in particular, the 9 Point Canadian Senior Debt Fund. 9 Point Canadian Senior Debt Fund. And so, for example, they did a post in August called 9 Point Private Debt Update, How 9 Point Failed to Live Up to Its Claims. So look, OPM is a paid subscription, and I want to respect that. I'm not going to talk too much about their actual content, but I will be referring to it. And if you want to look at the OPM site, I've written it down here somewhere. I think it's just opm.com. Maybe it's opmwire.com. Check those out, but maybe it's in my notes as I go down here further. Oh, there we go. opmwire.com. Go there, subscribe. You can read this yourself. I don't like stealing other people's contents when their model is a paid subscription. Also, I didn't read the terms and conditions, but I'll refer to them, give them a little plug here. So why am I talking about this? Well, the 9 Point Private Debt Funds are something that we at Sinclair Range know quite a bit about. Why is that? Well, a number of reasons. First, we pay attention to this distressed debt world. And 9 Point has been a significant funder of distressed debt. And in Canada, 9 Point's basically blown up in this space. That's not a factual allegation of any sort. It's just my judgment on the issue. And the funds that they're being managed by third parties, I'll explain that in a minute, they've kind of all gone away too. And so there's just this huge gap. We've talked about it in the inner circle deals and capital. There's probably $1 billion to $1.5 billion need for 13% to 18% financing for mid-market and smaller businesses in Canada alone. I'm not talking about the US, which has a healthy market, by the way. It's Canada where the problem is. And a lot of that, in my judgment, comes from the 9 Point problems. And so we are interested at Sinclair Range. We pay attention to this space. So that's reason number one. I find this interesting. Reason number two is that Sinclair Range is friends or friendly with more than one of the fund managers that 9 Point has used. Now, the structure of the way these things work is that somebody like 9 Point would be the fund company, and they would create this structure, and they would go, in this case, to a retail market, meaning you and me, and they'd say, hey, buy a mutual fund unit trust and put it into your RSP or whatever, depending on the deal, and they would raise a bunch of money. And what we're going to do with that money is we're going to do $10 million bridge loans, asset-based loan, not just $10 million. I'm just using an example. It could be $100 million, whatever. We're going to put it into mid-market businesses and be their bank, because there's a whole world out there that can't borrow from the banks, particularly at certain times of the cycle, and in Canada, where I'm sitting right now. So that's basically the pitch. But 9 Point itself, in this case, or any fund manager really, or very few fund managers, actually do the administration. Instead, they partner with an agent, an advisor. And what that agent does as a third party is it does all the work. So it hangs up a shingle, and it says, we are a financer of businesses, and we find deals. So we do the business development, we do the underwriting, we do the collateral analysis, we do the due diligence, loan administration, and we try to collect. And we do the reporting. So the agent would report, the fund manager, for lack of a better word, would report to 9 Point. 9 Point would report to its unit holders in general. That's kind of the way that it works. And the agent does that for a fee. And the fee could vary all over the map depending on the type of fund and who's negotiating and whatever. But at the end of the day, you often just see an administration fee, some fixed amount tied to the assets under management, how much money the agent is managing, for lack of a better word, and an upside fee, right? And so that would be your typical 2 and 20 hedge fund model, although not normally that simple, okay? So for example, at the 9 Point Canadian Senior Debt Fund, the agent manager, according to OPM, would be a company called Wagar Capital. And I can confirm at Sinclair Range, can confirm that that's absolutely true, because we know Wagar very, very well, and I like them very much, by the way. Good, honorable people, I think, and I can confirm that they are in fact the agent for that particular fund, the 9 Point Canadian Senior Debt Fund. Were the agent. I think that those guys have separated. So we're interested in this, one, because we're interested in the space, two, because I know the people, and not just them, others as well that have all related to this. What we're going to learn is a mess. Third, some time ago, when the 9 Point Canadian Senior Debt Fund had, say, $380 million of assets under management, don't hold me to that number, but somewhere in that range, they had all this money that they had to manage, but they had no liquidity, right? So they've lent this out. They've got positions in different companies, but they're unable to, in their disclosures, I believe, fund, or certainly according to OPM, they can't fund redemptions. So what you do in a fund is called ring fencing, which is you say to these investors, the retail investors, you and me, I can't give you your money back right now. I know you want your money back. I know that my agreements say I'll give you your money back, but I also have the right to not give you your money back because I don't have any cash right now, right? And so they had this problem going on, and no fund manager of any credibility or sponsor wants to be in that position. And so I was asked by a group out of the US to look at this, and we did on the quiet, and we ended up offering, I don't remember the number. I think it was initially 80 cents on the dollar, and then it was 85 cents on the dollar, which maybe is 320 million, something like that, to buy all the assets of that fund. And then, of course, we would have worked with the Wagar people on the agency side, but that would have created liquidity, and it would have been probably a pretty good solution for the unit holders of the 9 Point Fund at that time. We'll talk about on future episodes what happened in that deal. Now, one of the caveats of that offer, by the way, was that it wasn't just blindly, hey, we'll give you $320 million. It was tied to what's called a vetted borrowing base. In other words, you say in your reporting, Mr. 9 Point, that you have $380 million of loans of value. I'm not so sure that's true. I think if you start digging into it, we might find that that $380 million is worth less in reality, because you've lent too much to these businesses. They don't have the assets to cover it. And so from a loan valuation perspective, not so much. And the math for that is done on a spreadsheet, which is called a borrowing base. And so this was, hey, we'll pay you 85% of, again, I don't remember the exact number, but something in that range, 85% of the vetted borrowing base. Not 85% of 380, but so if you believe your 380 is worth 380, it's 85 of 380. But if you believe your 380 is worth 100, well, that's a different problem for you and the unit holders of the fund. I'm not saying they believe that. I'm just trying to give you an example. So we worked on this offer at Sinclair Range. And because of that, we had several discussions with the people directly at 9 Point. We did all the due diligence that we could at that time. We read all the fund disclosures, of which there is limited information, but also all the legal pleadings. The 9 Point people are directly or indirectly involved in lawsuits from borrowers, certainly more than one. And so you get to read through the affidavits and the legal pleadings and see what the allegations are and try to get your view on what the assets are worth. So we did all that work. So that was number 3. We pay attention to the space. We know the people. We tried to buy the assets and did the due diligence. Number 4, Sinclair Range owned a wholly owned subsidiary, was a small borrower of that exact fund. So ironically, if we had bought it, we would have bought our own debt, which, was a different little issue, but it was a really minor piece of the overall issue there. But because we had a borrower in our portfolio of that particular fund, we have firsthand information from the other side of this issue, this other side of this equation. And it was an unmitigated disaster. I've never seen a funding company behave like this. My personal opinion, not a specific allegation. And so we have interest from that perspective. And 5th, this week, we've Sinclair Range entered into litigation with 9 Point. I'm not sure which exact entity of 9 Point, but one of the entities, and we'll get more details on that. So there's an introduction to the issue with 9 Point. You can go look it up on OPM, but I'm not going to say too much. I'm not going to talk out of school, but it's fair game to tell you facts about our experience with this fund, with the players involved in this fund, with what I see as failings in the disclosure and the litigations that are ongoing. Those are all fair game for us to talk about. And the intention here is if we're going to have a fight, let's have a fight. Let's do that. Let's talk inside baseball. Let's bring you along for the journey. I mean, hell, that is the point of this live stream. Anyways, at this point, I would normally do my musings for the week, but I will not because we're over our 30 minutes into this. Thank you for listening, everybody. Thanks for all the kind words. People have reached out to me. And if you, in your business, are going through a transition, and we exist to help you. If you are navigating high growth, navigating financial distress, need to get some deals done, reach out and let me know. Anything on Instagram I need to look at? I don't see anything. I think that's it. I think we're done. Thank you, everybody. We'll see you next week on the Sinclair Range Week in Review.